On June 27th, the Reserve Bank of India will conduct a Rs 1 lakh crore variable rate reverse repo auction or VRRR. The move comes as India's banking system is flush with excess liquidity, almost Rs 2.44 lakh crore as of June 23rd, according to RBI data. So what exactly is VRRR? In simple terms, VRRR is a tool the RBI uses to temporarily suck out excess money from the banking system. Here's how it works. Imagine all the banks have too much money. So much money that they don't know what to do with it. They can't spend it all, and just keeping it isn't helping anyone. Now the RBI is like the grown-up who takes care of everyone's money. RBI says that, hey banks, give me some of your extra money for a few days. I'll keep it safe and give it back to you soon with a little extra as a thank you. This is called VRRR, or the Variable Rate Reverse Repo. It just means that RBI is borrowing extra money from banks for a short time, so there's not too much money lying around and causing problems. The RBI borrows money from banks for a short period at a variable interest rate decided via auction. In this case, the RBI will borrow Rs 1 lakh crore from banks on June 27th and return it on July 4th. The last time RBI conducted this operation was in November 2024, but it received a muted response from banks, with only Rs 2,476 crore of funds parked with banks as against the proposed amount of Rs 25,000 crores. Now, why does this matter? Well, too much liquidity, meaning more money than the banks need, can cause several economic side effects. There can be increased lending and risk-taking. It encourages lending, and when banks have extra cash, they want to put it to use, so they lend more. That's good for economic growth, but it also increases the risk of reckless lending or risky investments. There will be pressure on asset prices and inflation. Asset prices could go up. Surplus funds often flow into markets, stocks, bonds, real estate, pushing prices higher. This may inflate bubbles, and when too much money chasing too few goods, inflation kicks in. Lower interest rates. With banks desperate to lend, they offer loans at lower interest rates. While this helps borrowers, it might limit RBI's ability to further cut rates to stimulate the economy if needed. Weaker monetary policy transmission. This is called a liquidity trap. Even when the RBI changes interest rates, the economy doesn't respond as expected because there's already too much money floating around. And potential financial instability. If banks or investors take excessive risks in search of returns, it can lead to asset bubbles. When those bubbles burst, it can trigger a crisis. Finally, India's excess liquidity can flow into international markets, influencing global capital flows and financial stability. So these are the main reasons why RBI is trying to drain out up to Rs 1 lakh crore via VRRR. For more news and updates, keep watching Live Mint.